How are you guys? This is Javier from the Thrive team at Compass, and I am here to give you a quick run through on the financial Rebny statement, which is a document that you will have to fill out anytime you're making an offer for a condo or for a co-op. So let me move myself. Whoops. Let me move me around here. That's probably a better spot for this to happen. So this is the statement. This is Google Documents. We have it also in Excel, which is what I prefer to share with my buyers. But just in case you prefer Google Documents and because it's easier to record, here's what it is. We have 3 pages, page 1 here, page 2 here, and page 3 here. And I'm going to go really quickly over what these pages are so you don't feel intimidated by all these little yellow blocks here. So name and address, very straightforward. This is your name as a buyer, John and Jane Doe, I guess. And your address, 123 Main. This is not the address that you live at. This is the address where you want to make the offer. And it just states that you're accurately stating this. When I meet with buyers at the beginning of the process, in our consultation at the beginning, we talk about these numbers right away. So there's usually 1 applicant or 2 applicants in a purchase. This is more important for co-ops than for condos, but you still want to have it ready for condos because it's going to show up in the condo application too. So the applicant and the co-applicant, usually the applicant's going to be the one that has the highest income or the highest credit or whichever shows first in the bank. There's really no rule here. What it's important here is that when you are putting numbers in each one of these cells, that they're actually accurate numbers. For the presentation of this to the co-op, it has to be to the penny that is in the latest bank statement that you are presenting. So let's go over this different assets that we need to record. Cash in bank, very straightforward. Let's say John has 100,000 in the bank and Jane has 250,000 in the bank. So then money market funds, that's savings. We have 50,000 here. I know these are approximations, but in general, imagine that these are just real numbers. Contract deposit. So this you're not going to fill up at the beginning of your consultation, but you are going to fill it up once you have put the money in the property in contract, which is when you have to present this to the board in your application. So this is your contract deposit. Let's say here that we're buying a $1 million property. So you come here and just start populating here in our fictitious world. A $1 million property at 123 Main Street, New York. That would be probably in Roosevelt Island, although I think that place doesn't exist. And you're putting as a down payment 20%, which is 200,000, and your mortgage rate, let's be kind here, and it's at 89%. 5.89%. I'm kind of like making out these numbers here. And a 30-year fix, right? I'm filling this up because I want to make sure that I know the purchase price of the property, because every time you have a contract deposit, it is usually half of what 10% of what the price of the property is. So that's for ease. Then stocks and bonds, see schedule. So this is going to be recorded here in the stock bond page here. If we pull out a little bit, this is going to have a scheduled bonds, scheduled real estate, and schedule of notes payables. These are money that you owe, that you hold some collateral in. This is very rare that I see that in New York, but it could be something that exists. So let's go back here to our financial statement. Let's keep filling it up. Let's say we do have some stocks here. We have $30,000 in stock, and he has $50,000 in stock. Investment on your own business, usually none. Accounts on notes receivable. This is money that people owe you. Real estate owned. Let's say these people are first-time home buyers, so they don't own real estate. Automobile, they don't have an auto. Personal property, this is basically the stuff that you own. Art, furniture, personal matters, your record collection, anything that can have attached a dollar value to it, you put it there. Life insurance, this is if there's like a cash value of the life insurance. Most life insurance don't have a cash value unless you have a term life insurance, not term, whole life insurance. I don't work in life insurance, so talk to your life insurance agent or your insurance professional about whether you have any cash value there. And these are your retirement accounts. So this is money, these are assets, these are not liquids. Actually, liquid is your cash, your money market accounts, and that's about it. Everything else is not liquid asset. If you had profit share or pension plans or anything else you can write in there or any other, you can see that this sheet does the math for us. So this specific buyer here, they're very well positioned. They have almost 700,000 in assets. That's not all liquid though. We'll see the liquidity of it later on. But they're doing good. What's their salary? They're both professionals in their field, and they do very well. So he makes 250,000. She does a little better than him. Then overtime wages, they don't get paid, but he does get paid a commission. And she also gets paid like a bonus. Maybe her bonus is a little shorter because she has a different kind of work that's not based on performance. Dividend and interest, this is any money that you make from stocks, your real estate income if you own rental property, how much you're making, and any other income, your Etsy shop or whatever it is that you're doing on the side. So that's their income annually. This is not added together, it's just kept there, but they actually have a very solid income. They probably should be buying something bigger than just $1 million, but hey, to each their own. And here, the general information, your bank accounts. This is funny because a lot of people just write here. Don't write here with letters. This is for it to look like this. In Chase, I have $100,000. And in Bank of America, I have the other 50,000. Whoa, no. 50,000. That, yeah, say that, whatever. And same here. Let's say he has 250 right there. I don't know why that's in bold, but there you go. So that's the first column. Let's go to the liability side. This is what you owe to bank, to relatives, to others. Installment payments, mortgage, automobile, student loans, loan of life insurance policies. Some people, if they have cash in life insurance, they pull it out. So let's say they have student loans. They have big student loans actually because they are high earners. So they have a lot of money there to pay. And that is their liabilities. So when this number here that I'm putting there in blue is basically this, your total assets minus your liabilities, gives you your net worth individually, and this is the combined net worth. This is actually incorrect, and I am going to fix this here. Sorry. Total liability net asset. Yeah, so it should be 30 and 30. And this is the actual number, right? This is broken here. I need to revise this here, but it should give us a number like that. Everything that we own minus everything that is owed, and that's the actual net worth of the whole thing. And then there's something called contingent liabilities. As endorser, I'm gonna go through them really quickly. As an endorser, these are the things that you gotta pay attention to. If you co-sign a loan with somebody else, you should be putting a number here, the number of the loan or what you're responsible from that loan. If you pay alimony, you also put some money there. If you pay child support, you also put some money there. In this case, these people did not have any of them. Then if you're defendant to a legal action suit, yes or no? Have you been unsatisfied judge? Do you have an unsatisfied judges? Yes or no? And bankruptcy, if you have to explain it, hopefully it's no. And then these are projected expenses. This is also important. How much you have in maintenance? Don't put that. Don't fill this out. This comes from the other page. And then financing should also come from the other page, but this is actually a broken link, so I'm going to bring it up when we do the other thing. And any other mortgages you have, any other bank loans you have. And so let's say the other loans, which are student loans, let's say they pay together like $1,500 in student loans. And that's your total monthly payments aside from everything that's going to come here. So here you would go and define the stocks that you have, the amount of shares. So you have 400, so you have 400 shares in Apple stock, and the marketable value is how much value that stock is trading on the day that you produce the last bank statement from your brokerage account. Not the day of the thing, not the day of and if you think that it actually went up and that's going to help you, then produce another statement before you send this, produce a screenshot before you send this. You have to back this up in your documents. And if it's a non-market value, that would be like a CD. It's something that cannot be sold right away, or bonds are also non-marketable value. You cannot just trade a bond or trade a CD on the open market. These are things that are going to mature at some point. Then if you own real estate, what's the location, how much it costs you, what's the actual value, if you carry a mortgage, and when does the mortgage expire. And this is if you have any asset as a collateral into any loan that you have. They want to know, because you might own real estate assets and you're using them as a collateral for other loans or stuff like that. You put that there. And if you, so this is the purchase analysis. Why is this important? If you're purchasing in a co-op, you will have to go through the board approval. Part of the board requirements for a co-op is usually a low debt to income ratio between 20 and 27, depending on the co-op. More likely 23 or 24 is what they're looking for. And then they want to know that you're going to have post-closing liquidity for this unit. So post-closing liquidity means that they want to know that after you close, you're going to have at least a year or two, depending on the co-op again. They have different rules, different parameters, but they want to know that you have a year or two of money left in the bank to cover in case something happened to you. So let's do the cost analysis here. We know our annual salaries, we know our bonuses, make tons of money. There's no other income. This is the total income of this couple. This is the property they're trying to purchase. This is how much they have to put down. This is how much they're going to be. That's funny. This should actually also do the math. Total cost of your mortgage. So this should show up here. So it is going to start showing up in the sheets that you get. It's going to show up. And then the maintenance here, let's say the maintenance on this home is $2,000. So that is the monthly debt services, or the monthly cost of ownership, really, because these $2,000 are not debt services. So I believe this is not properly named, but here is how much annual debt service you're going to be paying, $100,000 a year. So your debt to income ratio on the salary only is 18.8, and once you count your bonus is 12%. So they're very, very good. Let's say, just to make stuff up, if this was a $2 million property, $2 million property, that percentage there would be a little higher. With a bonus, it would pass, so it would still be okay. But we are looking at a $1 million property, right? So let's keep it clean and clear. These are numbers, 18%, good. Let's keep going down here. This is what we filled up in the financial statement is showing up here. How much liquid money you have, how much stock and bonds you have, retirement funds, others. This seems to be clock. We have to reconnect it. So in terms of liquid assets, we're looking at this number. And then you have your down payment, your closing costs. Let's say your closing costs are around 2% of the cost of the property. So that's $20,000. So you come out of pocket to $120,000, and that gives you 45 months of liquidity. So if you were applying for this co-op, you would pass. if you were not applying for this co-op, then you know that you would pass. But you are in a very good position. Now, I know these are not the numbers for everyone. These are just like examples that I pulled up, and these are very specific kind of person. John is an attorney and Jane is a doctor, and they're actually young and they can make even more than that. But that's how you use the Rebny financial form. And once this is set up and we're submitting an offer for a co-op, we need to submit this in PDF form with your offer form and with your pre-approval letter or proof of funds if you're financing or if you are paying cash. Thank you so much for listening. I hope you found this useful and this takes you through the whole process really quickly. And if you don't have any questions about any of these things, feel free to reach out or comment down below or shoot me an email and we can discuss. Take care.